Cost Volume Profit Analysis, often abbreviated as CVP, is a fundamental tool that every business owner and manager should have in their toolkit. Imagine you're at the helm of a ship navigating through the turbulent waters of the business world. CVP analysis is like your compass, guiding you through the complexities of costs, sales volumes, and profitability. It's all about understanding how changes in these areas can impact your bottom line. So, let's dive deep into everything you need to know about CVP analysis, its importance, and how it can transform your business decisions. At its core, CVP analysis helps you understand the relationship between costs, sales volume, and profits. Think of it as a financial map that shows you where you stand and where you need to go. One of the key concepts here is the break-even point, the magical moment when your total revenues equal your total costs. It's crucial because it tells you the minimum sales volume you need to avoid losing money. And let's be honest, nobody wants to be in the red. Now, why is understanding CVP so important? Well, let's start with pricing decisions. Imagine you're launching a new product. How do you know what price to set? CVP analysis allows you to determine the most profitable price point by analyzing your costs and expected sales volume. You can figure out the minimum price you need to charge to cover your costs while still making a profit. This is invaluable information when you're trying to find that sweet spot where your product is both attractive to customers and profitable for you. Next up is effective cost management. Knowing your fixed and variable costs is like having a secret weapon in your business arsenal. Fixed costs, those expenses that don't change regardless of how much you sell, like rent and salaries, need to be covered no matter what. On the other hand, variable costs fluctuate with your sales volume, like raw materials and direct labor. By understanding these costs, you can identify areas where you can cut back without sacrificing quality or efficiency. It's all about working smarter, not harder. Let's not forget about improved financial forecasting. With CVP analysis, you can make educated projections about future sales and profits. You can estimate the sales volume required to break even or achieve specific profit targets. This is essential for budgeting and planning your business's growth. It's like having a crystal ball that helps you anticipate market changes and adjust your strategies accordingly. Strategic decision-making is another area where CVP analysis shines. By analyzing your break-even point and profit margins, you can make informed decisions about product mix, sales volume, and pricing strategies. For instance, if you find that one product has a significantly higher profit margin than another, you might decide to focus your marketing efforts on that product. It's all about maximizing profitability and ensuring your resources are allocated effectively. Performance measurement is also enhanced through CVP analysis. By tracking sales volume, costs, and profitability over time, you can identify trends and patterns that inform your decision-making. This data-driven approach allows you to make adjustments that improve financial performance and boost profitability. Now, let's talk about the benefits of CVP analysis specifically for business owners. First off, it improves profit planning. By understanding the relationship between costs, revenues, and profits, business owners can develop accurate profit plans. This means you're not just flying blind. You have a roadmap that helps you navigate your business financial landscape. Efficient resource allocation is another perk. CVP analysis helps you identify which products or services are the most profitable. With this knowledge, you can allocate your resources more effectively, focusing on the areas of your business that yield the highest returns. It's about minimizing waste and maximizing output. Evaluating your break-even point is crucial as well. Knowing the level of sales you need to achieve to stay afloat is empowering. It gives you a clear target to aim for and helps you set realistic sales goals. Plus, it informs your pricing strategy. If you know your break-even point, you can adjust your prices accordingly to ensure you're covering your costs. Better cost control is another significant advantage. By identifying fixed and variable costs, you can evaluate your cost structure and minimize unnecessary expenditures. This not only helps you maintain profitability, but also allows you to adjust your prices or production volumes in response to market changes. Lastly, CVP analysis enhances performance measurement. It allows business owners to track their performance in terms of sales volumes, revenues, and profits. By setting and monitoring performance targets against benchmarks, you can identify opportunities for growth and improvement. Now, let's break down the components of CVP analysis. First, there's sales volume, the number of units sold in a given period. This is a critical component because it directly impacts your revenue. Next is the price per unit, which refers to the selling price of a single unit. This is crucial because it affects the revenue generated for each unit sold. Variable costs come next. These are costs that change with sales volume, like direct labor and raw materials. By analyzing these costs, you can determine how much it costs to produce and sell each unit. Then we have fixed costs, which remain constant regardless of sales volume. Think rent and salaries. Understanding these costs is essential for calculating your break-even point. The contribution margin is another key component. It's the amount left over after subtracting variable costs from total sales revenue. This represents the income available to cover fixed costs and generate profits. Finally, we have the break-even point itself, which is calculated by dividing total fixed costs by the contribution margin per unit. This is where the magic happens. You find out how many units you need to sell to break even. Now, let's address some common misconceptions about CVP analysis. One of the biggest myths is that CVP analysis only works in the short term. While it's often used for short-term decision-making, it can also be applied to long-term strategic planning. It helps businesses forecast future sales and expenses, making it a valuable tool for both immediate and long-term decisions. Another misconception is that CVP analysis doesn't consider fixed costs. This couldn't be further from the truth. CVP analysis takes both fixed and variable costs into account when analyzing profitability. In fact, understanding fixed costs is crucial for determining your break-even point. Some people believe that CVP analysis assumes constant selling prices and costs. While it's true that the model simplifies things by assuming these remain constant over a relevant range, it can be adjusted to account for fluctuations. This flexibility means it can still provide valuable insights even in a changing market. Another myth is that CVP analysis doesn't apply to service industries. This is simply not true. CVP analysis can be used effectively in service industries to determine break-even points and profitability, just like it can for product-based businesses. Lastly, there's a belief that CVP analysis doesn't consider changes in the sales mix. In reality, it does. Changes in the sales mix can significantly affect profit margins, so businesses need to calculate a weighted average contribution margin to determine their break-even point accurately. So, how is CVP analysis used in businesses today? It's a versatile tool that assists in various aspects of decision-making. For pricing decisions, businesses can use CVP analysis to determine the optimum price for their products and services, ensuring they remain competitive while maximizing profitability. When it comes to product mix decisions, CVP analysis helps companies identify the best mix of products to maximize profits. By evaluating the contribution margins of each product, businesses can allocate resources effectively and focus on high-margin items. Sales volume analysis is another critical application. By understanding the relationship between sales volume and profitability, businesses can determine the break-even point and the minimum sales volume needed to cover production costs. This insight is invaluable for setting realistic sales targets. Operating leverage analysis is another area where CVP analysis shines. It helps businesses determine their operating leverage level, measuring the sensitivity of profit to changes in sales volume. Companies with high operating leverage can see significant profit changes with minor sales volume variations. Finally, CVP analysis is a valuable tool for budgeting and forecasting. It enables businesses to project future costs, profits, and sales volume accurately, which is essential for making informed investment decisions and expansion plans. Calculating CVP analysis involves several steps. First, determine the sales price per unit by dividing total revenue by total units sold. Next, calculate variable costs by multiplying the variable cost per unit by total units sold. Then, determine the contribution margin by subtracting variable costs from revenue. Next, calculate fixed costs. These are your expenses that don't vary with production levels. After that, compute the break-even point by dividing total fixed costs by the contribution margin per unit. Finally, determine profitability by using the formula: profit equals sales revenue minus variable costs minus total fixed costs. However, it's essential to recognize the limitations of CVP analysis. One significant limitation is its assumption that all costs are either fixed or variable. In reality, some costs can be mixed, complicating the analysis. Additionally, CVP analysis assumes a constant sales mix ratio, which may not hold true in dynamic markets. Moreover, it assumes no changes in market conditions, which can significantly impact sales volume and pricing. Lastly, CVP analysis relies on the assumption of perfect cost and revenue behaviors, which rarely occurs in real-world scenarios. Despite these limitations, CVP analysis offers numerous advantages. It helps determine the break-even point, facilitates pricing decisions, and enables informed product mix decisions. It's also invaluable for budgeting and planning, allowing businesses to assess the impact of cost changes and make decisions in complex scenarios. To make the most of CVP analysis, organizations should follow best practices. First, identify relevant cost drivers. Understanding what drives your costs is crucial for accurate analysis. Analyze your sales mix to determine which products are more profitable and focus your efforts accordingly. Determine your break-even point to inform your pricing strategy and calculate your safety margin. Incorporate sensitivity analysis to evaluate how changes in key variables impact profitability. Continually monitor and update your CVP analysis to ensure it remains relevant. Finally, leverage technology to streamline the analysis process and reduce the risk of human error. When analyzing CVP results, common errors can occur. Ignoring fixed costs, overlooking the impact of price changes, and neglecting variable costs are just a few examples. Failing to consider the timing of costs and changes in the sales mix can also lead to inaccurate conclusions. Responsibility for interpreting CVP analysis typically falls on senior management, finance executives, and the accounting team. Each plays a crucial role in ensuring the analysis is used effectively to inform strategic decisions. In conclusion, mastering cost-volume profit analysis is essential for any business owner or manager. It's a powerful tool that can help you navigate the complexities of pricing, cost management, and profitability. By understanding the relationships between costs, sales volume, and profits, you can make informed decisions that drive your business forward. So, don't wait. Start implementing CVP analysis in your business strategy today and watch your profitability soar.